Hi everyone, it's Alex here at Session Capital Research. Welcome to our weekly webinar. It's Thursday, the 4th of January, 5 p.m. Eastern. So welcome to all of you here who are either Growth Investor Pro subscribers from our Seeking Alpha service or Tech Select Pro subscribers from our Substack service. It's our first weekly webinar of the new year, and clearly markets are looking a little bit different in January to how they were in December. So I want to spend some time looking at the US equity indices. It's pretty important we do that right now, I think, and it's important that we zoom in and take a shorter term look as well to see, what's going on in markets right now. We've had a number of questions in recent days about, along the lines of, which are good stocks to buy now, and reasonable question, hard answer. And so having looked through, our stock ratings, there's not many we've got rated at accumulate right now, but I want to highlight a few of those and give the logic to those. And there's looking at them, there's a factor that links them all when I sit back and take a look. So we'll talk about that. Before we do anything like that, house rules. So we operate on a live open mic basis. If you have any questions, points, comments, anything, easiest way to get that across is just open your mic and shout into the system so everyone can hear you. If you're not able to do that or you prefer not to, then you can post questions using the question or the comment functionality in this webinar platform. Alternatively, if you're a Growth Investor Pro subscriber, then use the chat room there, and I can see questions pop up there and read out for the benefit of other people. Before we do anything though, let's move on and do our disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material or potential conflict of interest or impacts the content of its research or publications. Okay, let's do index review first. Let's get these on your screen right now. Okay, so I want to do larger degree and smaller degree in each of these, and it's really important to zoom in at present as well as zoom out. Now, on your screen right now, you have the SPY ETF, that's the S&P 500 largest ETF. And for those amongst you who are Inner Circle subscribers, this chart will be familiar to you, which is we've got two cases superimposed here. The base case assumes that this current upcycle started in the 2015-2016 lows. And this is the one we've been tracking for a couple of years now. It's tracked pretty effectively to standard Elliott wave and Fibonacci patterns. Let me show you. So from the lows back there, we get a wave one high into the pre-COVID peak. That's around February 2020. We get a 78.6 retrace into the COVID lows. That's an absolutely textbook wave two, which is why it looks like the start of the wave one might have been in 2015, 2016. We then get a wave three up. The peaks at the end of 2021. It was a 1.618 extension, textbook wave three. And then a 0.5 wave four down that troughs just above that wave one high. So a good wave four. And then we're on the way to a wave five high that probably will terminate somewhere between 530 and 585, let's say. And if that happens, and still that remains our base case projection, then we would expect then to see a peak in the S&P sometime mid-late this year before a pretty strong sell-off at that point. Now, this is only pattern recognition. It's not any kind of, prediction machine, but the patterns work reasonably well over time, particularly in the equity indices. The other view, though, here is, well, you know, the world got a reset in the COVID lows. Everything changed. Monetary policy changed. Consumer behavior changed. Um, Work behavior changed. Technology, everything changed. And so maybe it makes sense to start the count at this March 2020 low, in which case this is point zero here. This here is not a wave three, it's a wave one. And this is a much more bullish outlook, by the way. So this is a bull case wave one high here. This is a bull case wave two low here. It's not very deep wave two, but then in big bull markets, you don't get very deep wave two. It's 0.5 retrace. And if this bull case is to be believed, then we may be in a wave three up right now, which may not peak before even 780 on the SPY, which sounds preposterous right now. So it's not even worth talking about. But technically, it's a possibility, and certainly 2023 felt like the beginning of a wave three up. It was unstoppable. Whatever anyone wanted to say, fact is, since the October 22 lows, the market was unstoppable. It was a pullback between July and October last year, but apart from that, it was only up. And if you believed price, if you believed what you saw before you and you followed it, and you ignored all the narratives all over financial media about recession and rates and inflation, if you just followed price, then you did really well in 2023. So all good, right? Well, not quite, because let's zoom in. So to zoom in, we're going to use the ES futures. This is the S&P futures. And we use this for shorter term price analysis. The reason we use it is because futures have longer trading hours than equities. In addition, certainly in any volume, it's institution only. Obviously, some individuals trade futures, but not in market moving volumes. And so it's a good read, this on what's happening with big money. And this is what's happening. Okay, so this low here is the October 2022 low. And this was the end of the 2022 bear market. We get a rapid rise up for a wave one high into the middle of December 22, a wave two down, a 61.8 wave two down into the end of December, and then a wave three up into the end of 2023. Actually, technically, let's remove that up a little bit. That peaked right at the end of the year. And it's a really righteous chart, this. It really works very, very well. So this wave three that runs from December 22 to December 23 takes in a full 1, 2, 3, 4, 5 wave pattern. And it's almost perfect, with the exception that this wave four it breaches that wave one high, which isn't technically perfect. If you look at the index rather than the futures, it's a bit prettier, but that's the only blemish on this chart. And what we've been saying in this chart for some weeks and months now is, look, this wave five here, 5 of 3, this will likely terminate somewhere between, let's say, 4650 on the futures and 4800 on the futures, and actually overshot a bit, which, these wave five termination zones they happen more often than you think in this zone. And so I sort of felt like, well, that's running up a bit far. And if you've seen any of my commentary in various services, you'll see that, I've been expecting some sell-off, and I think it's here. So I think that we are going to see some sustained weakness in the S&P as part of an overall, again, zoom out, we are in an overall bull market. I'm confident of that. But near term, I think we're going to see a sell down. Now, how far down? Well, technically speaking, we're now in this wave 4 down on this time scale. So this is, for the avoidance of doubt, a 5-wave cycle that started at the low of the 2022 bear market in October. There's your 1, there's your 2, there's your 3, and here comes a 4. Now, technically speaking, a 4 shouldn't go much lower than the prior wave 1 high, which means the S&P probably won't drop below, let's call it 4220 on the futures, 420 on the SPY, there and thereabouts. And it can do that and still be in an overall bull market, no problem. But I don't think anyone is particularly expecting the SPY to drop to 420 or futures to drop to 4200. If they do, you'll see, screaming and 2023 was a fake out and all of that. But that's not true. We could easily drop to 4220 on the futures, 420 on the SPY, and it's just a technical correction as part of a longer bull market. So I don't know if it'll go that low. I'd be a bit surprised, to be honest, but be ready, right? This might happen. So you'll have seen, if you're a Growth Investor Pro subscriber, you'll have seen me applying hedges today to my personal long index equity positions. I'm now net short the S&P in anticipation of this. So I'm about 2-to-1 using SPXU on the short side and UPRO on the long side. Those are the 3x ETFs, with the idea that if we do get a sustained sell-off, to try to make some money from that. And per the equity index plan that you can see on our website right here, just go to sestringcapitalresearch.com, click indices, and you can see how we think about equity index trading. Long note here that you can read. Per that plan, if this sell-off happens, my 2-to-1 short position should generate some nice profits in the short leg, which at some point I will liquidate, take that profit, and use that to buy additional long positions in the S&P. Now, let's look at the Nasdaq. So let's look at the QQQ. Same thing. Here are two charts, base and bull case overlaid. So base case here starts at the 2018 lows. That was an important low. Monetary policy change then. A really rough year in the Nasdaq in 2018. Did a big about turn and put in a terrific 2019 and early 2020 before COVID came along. So the base case is a wave 1 up there, a wave 2 down here. You can't see it here, but that's a 78.6 retrace. A wave 3 up, which again you can't see here, but that's a 2.618 extension. It's a really big wave 3. A wave 4 down, a 61.8 retrace that's tested 3 or 4 times. And then on this base case, we're now in a wave 5 up that we would expect to terminate somewhere between 405 and 446. Now, it may be that, in fact, the Nasdaq has hit that wave 5 high and is rolling over. And certainly if you were to look at, for instance, Apple, which is such a huge component of the Nasdaq and the S&P and the Dow, Apple chart does not look pretty, right? So it made this high here in July. It did a double top here in early December, and it's just dropped there. And Apple as a company is in not wonderful shape. That's only partially related to the stock price, of course, but there's certainly plenty of headwinds against company earnings growth and revenue growth. So Apple weakness is never good for the market. If you are long US equity indices, you want Apple stock to be on fire, and it isn't. Let's go back to the Nasdaq for a moment. So it's possible that the Nasdaq has hit its high, it's going to roll over, and we're now going to be in a sustained bear market. That's definitely possible. I don't think it's likely, personally, and one of the reasons I don't think it's likely is if we were to look at Microsoft, for instance, another big component of all those equity indices. Microsoft stock, again, there's your base and bull case overlaid. It might be rolling over, but I would be very surprised. I mean, I think enterprise spending is going to continue. I think Microsoft is set up for future solid revenue and earnings growth, and I would be surprised if that was the all-time high in Microsoft, the highest high we're going to see for some time. So I think we have some local problems in the Nasdaq, I think, and again, back to the QQQ. It's possible. Sorry for this to catch up. It's possible that the QQQ has hit this peak and it's going to roll over, but I don't think so. I think that the Nasdaq is going to run higher over the course of the year. It's an election year. At some point, I would expect to see rate cuts, maybe not as soon as people were expecting, but I would expect to see them. And all of that ought to fuel the Nasdaq. So I think we're going to see longer term more up in the Nasdaq. But let's look locally again. Let's look at the futures again. NQ futures. This is the same chart really as the S&P that we just looked at. So this is the 2022 lows, double low put in January 23, a wave 1 up, 2 down, 3 up, 4 down, and a 5 up. Now, on this scale, again, as we've been flagging for some time, I would expect this wave 5 here to terminate somewhere between 17,240 on the futures and 18,000-ish. And look, it rolled over a bit soon, which is sort of unnerved me a bit, because I would have expected the Nasdaq to keep moving up into there, and it hasn't. And I don't think it's going to without a bit of weakness first. So we cleared the 2021 all-time high, turned it into support on the 20th of December and the 21st of December. It then peaked on the 28th of December, and since then it's been only down. This is a daily chart, and it's blown right through that 2021 all-time high. So it looks like that probably there was that local wave 5 high, and in which case we can expect to see some form of A, B, C correction before setting off again. Now, I'm just drawing lines here. This is not particularly scientific. I'm not saying the Nasdaq is going to drop to 14,500, but it might do. A wave 5 up, when it corrects like that, it can often shed most or all of the 4 to 5 move. So time to be ready, I think, for some short-term weakness in the Nasdaq. Let's look at the Dow. So the Dow, this is the longer term view. Dow made an all-time high in December. It was the first of the indices to make a new all-time high, and it's just sold off a bit since then. Now, in this same base case pattern, actually there's a ton of upside in the Dow from here. I think it can keep moving up. Again, it needs Apple to get the shape, but I think that the DIA could go from the current 377 to 420 without it being a particularly aggressive chart. But if we were to, again, zoom in, and it's really important right now to zoom in. 2023 was an incredible year, particularly the last 3 months. Look at what the Dow did from October to December. It was only up. I mean, it's a huge, ridiculously huge move. This is what it did earlier in the year. So this is, you can see that this is the September 22 lows in the Dow. So we got a big move up. It corrected in a normal technical fashion. We then got a high in July, corrected pretty tough down into October, and then just moonshot up. Well, only up moonshots don't happen in securities markets. They always retrace. And so from the top that was struck here, which is on the YM futures here, again, we're using futures because there's more trading data. It's predominantly institutional volume, and so that's important. From the peak of 38,110, it could sell off down to somewhere between, let's say, 34,500 and 33,600. Now, again, I would be surprised to see a 78.6 retrace here, but it's perfectly reasonable for that to happen and still be in an overall bullish pattern in the Dow. So again, this looks like a wave 1 topping zone. It's really hard to call wave 1 tops as they happen because you don't know. You've got nothing to compare it against. Was that the top there? Turned out it wasn't, but it could have been. Was that the top there? It wasn't, but it could have been. So it might be that the Dow keeps moving up, but most probably I think we get some weakness, if only because the move from October was just insanely aggressive, and so far it's not broken convincingly the high that was struck at the end of December. It tried on Tuesday, but didn't succeed. But a big down day yesterday, a sort of a flat day today. It tried to break out, failed. So I think probably there's some weakness in store for the Dow, and just be ready. I don't see anything at the moment that says we're not going to see an overall up market in 2024, but be ready. Finally, the Russell, IWM. Okay, the IWM I find pretty difficult to chart. It's a bit of a mess, but as a simple take, we can say that if IWM is over 200, that looks bullish. If it's below 200, that looks bearish. And if you look, every single time IWM has hit 200 since August 22, it's sold off. So August 2022, that's January 23, July 23, December 23. It peaked above it here, fake out, and on the way down. And it really could drop all the way down to 160 because this thing is brutal. So I've made personally really, really good money using TNA. That's the 3 times long Russell ETF on the way up from October to December. I traded this quite badly, if I'm honest, which is I went too long in July. I expected a breakout, didn't come. I had to hedge on the way down. I didn't hedge well enough because I kept expecting it to turn around and it didn't. So this went quite underwater on the long side. I just held, added to it, average down, and did really well on the way back up here. I took profits on both the long and the short side yesterday in the morning, and then wound on some long and some short yesterday. So I'm now 2-to-1 short in the Russell. And if there's some weakness here again, I would plan to wait, try to cash gains on the short side, and then roll that into the long side. And again, if you're not familiar with that strategy, go to our website, sestrycapitalresearch.com, click on indices at the tab there, and it lays down there exactly how we think about US equity index investing and trading. Let's look at the Russell futures. Okay, so look, this is the RTY futures. Again, reason to look at futures, almost all institutional volume, lots of trading data, longer trading hours and equities. And let's look at this. So from the May 2023 low, we're going to move up a wave 1, 2, 3, 4, 5 up, a peak in August, brutal sell-off in end of July down to October, and then a huge V-shaped recovery was basically only up. There's a wave 1 up, a 61.8 wave 2 down into November, and then an only up move into the end of December, and that was a 300% Fibonacci wave 3 extension, and you don't see those very often. And when you do, they tend to sell off pretty hard afterwards, and this has done that too. So we've seen some big drops in the Russell. Don't be surprised to see this sort of thing, which is, okay, there's been a big drop. You may get a counter trend move, a B wave, and then another C wave. But a move up here, my expectation would simply be a counter trend rally. I do think we've got some weakness to shed here. Again, a 300% Fibonacci extension, that wave up there, they usually get corrected. Again, it all is part of an overall bull market. Nothing here argues against this being a bull market for 2024. But a move up like that does tend to get corrected down. How far? 61.8 retrace wouldn't be unreasonable in my view, and it could go to 78.6. And who knows? It could go all the way down. The Russell will do that to you if you're not careful. So that's the Russell. We've done the Dow, the Russell, the Nasdaq, and the S&P. In essence, a huge bull market in 2023, which again, if you follow price and you ignored narrative, you would have done very, very well. What's happened coming into 24, I think, is you've got people on a euphoric rush from last year. Either they did make money last year and have become convinced that it was going to be the same this year, or they didn't and they had FOMO, and you've got people looking to buy. And so what's happening is you're seeing institutional selling into that buying demand. Institutions, remember, it's really, the year end's really important for them. So performance reviews for funds and for individual fund managers will center around 31 December fund values. And so, where the fund might happen to be on the 15th of January or the 20th of February doesn't really matter very much. And so if all these things sell off hard in Q1, kind of so what if you're a fund? Quarter ends matter a bit, but only if you're a sort of a mid-level fund manager or a junior manager. If you're the individual running the show, then your quarter end matter that much. Your year end matters a lot. So don't be surprised to see weakness in Q1, which I would see as selling into strength by institutions looking to then, the same people would then look to buy at a lower level in Q1, early Q2, with a view to running that up through the year. We said this a few times in our market notes, and so far market action 24, all 3 days of it, whatever it is, supports that. So we'll see how it pans out. But in essence, we think time to be careful. Personally, in my index positions, I'm either 1-to-1 hedged or net short, and I'll probably start to shed some long single stock exposure over the next day or two as well, just as a protective measure. Nothing too alarming, but just to take some gains where they have it and free up some cash. Okay, before we move on to individual stock ratings, anyone have any questions, points, comments, anything at all they'd like to raise? If so, a couple of ways to do it. Either open your mic and shout into the system, or alternatively, again, if you're a Growth Investor Pro member, you can always type into the chat room here, or you can use the question function in the webinar platform. Okay, no questions. Then let's move on. On your screen now is our Stock Central tool. So whether you subscribe to our stuff through Seeking Alpha or Substack, this is open to you. I got a question in one of our chat rooms. Okay, question was, Alex, on the hedging, do you typically only put on a short if you have a corresponding long? Not always, but usually. And my reason for that is that, if you zoom out far enough, markets do only go up. I don't mean individual stocks here. I mean US equity indices. The S&P and the Nasdaq and the Dow, at least, can be relied upon to generally go up over time. The Russell is a more difficult beast, in my opinion, but the S&P, Nasdaq, and the Dow generally will go up if you wait long enough. And so don't much like to naked short those indices, because if you get it wrong, you don't have any chip in the game that's going up. Whereas if you're hedged, even if you're overhead short, but you have a long side then, and you're wrong and the market's going up, then at least you have something that's going up. So in general, yes, I only take on short positions when I have a corresponding long, but that's not religiously true, but it's generally true. So I hope that helps. Okay, so individual stocks. So we had plenty of questions lately saying, well, what's a good stock to buy? And we often find that when we get an influx of new members, which we have had across our services in the last month or two, which is great. And the challenge at the moment is it's quite a hard question to answer that. And it's a hard question to answer specifically because of everything we've just seen in these market charts. So if we go back to the short-term Nasdaq chart, when the Nasdaq's done this in the course of a year, and it's looking like it's going to shed some value now, it's pretty hard, in my opinion, to get all excited about buying growth stocks. But better, in my opinion, to either pick up special situations where they're beaten down for some reason or other, but they won't look pretty. They won't be things that anyone's very excited about buying. That's the whole point. Or wait, and I had a look through stock ratings, which are all updated as of yesterday, to see, well, what have we got rated at accumulate? The answer is not much. Most things are at hold. Some are at not yet rated. So ARM, for instance, I think just needs to settle after its IPO. Some are rated at do nothing, like Fortinet or Tesla, where they need to sort themselves out. The accumulate ratings are all what you might call special situations. And that's not by design. But when I looked through it today, I realized that that's the thread that links them all. There's something particular about each one of them, which is they're all kind of broken, but are showing signs of recovery. So if I had to flick through them, I'll pick a few out. So let's look at Docusign first. DOC. This, as you may know, is an enterprise software company. It's used for electronic document signing and storage and handling, all of that. Competes with Adobe, a number of other people. Stock's been a disaster area, as you can see, since it put in a high of 316 in the middle of August 2021, and since then it's just plummeted. Huge drop on earnings initially here and then here, and it's just weighed all the way down here. Now, the reason we rate Docusign at accumulate is very simply because that's what institutions are doing, it seems to me, which is look at the volume by price bars on the right here. That's these grey bars on the right hand side. Big volume spike. The clock here starts at the all-time high. So any stock bought in this zone of, let's call it 60 to 50-ish, that's all since June 22. Now, the low in most aspects of the market was in by the end of Q2 in 22. It limped on a bit. There was a spike lower in September or October, but really and truly, the market started moving sideways from around June in 22. And this one's no exception. So it looks to me very much like we have some accumulation here. And I believe that's because the company's going to get sold. And in fact, this was touted in the press a few weeks ago, the company was said to be talking to potential buyers. I don't know if they formally appointed advisors or not at this stage, but it looks like it may be sold, and so there's probably some upside there. Now that's unlikely to be a stock that doubles. I mean, it could happen, but most likely, if you were to think about a 20 to 30% premium from here, which might be available on the company being sold, then that's not a bad opportunity from this price. So that's one. That's Docusign, and that's rated at accumulate for that reason. Let's look at Fastly, FSLY. Exactly the same story. So Fastly, again, a 2021 darling. Stock's been a disaster ever since. But from around February 22, it started to trend sideways at relatively high volume. They've had some activist shareholders in there. They churned pretty much the entire senior management team. The fundamentals are improving. They're still not brilliant, but they're better than they were. And again, I think this is highly likely to be a company that is sold to someone like an Amazon or a Cisco or someone like that. So again, is this going to reclaim its past highs? I don't believe it is, no. But could it pop 20, 30, 40, maybe even 50% on an acquisition? Yeah, it could. And so this is one where that might be of interest to accumulate. Again, I personally wouldn't be buying any of these on the basis that the company was going to recover by itself. They all have their own individual challenges, but as potential acquisitions by larger players, then they have some potential, I believe. Next, Mataport is a tiny, tiny, tiny microcap, so huge risk here. This is not for the faint of heart at all. Same story, 2021 darling. It was a SPAC stock, fell off a cliff. Sideways action since, again, Q2 22. This also is something of a play on the real estate market. What this does is helps to digitize the built environment, and it's used by realtors, commercial building owners, developers everywhere. It's our competitors, but not many. And so at some point, I would expect, first of all, the company to start to perform better as rates come down and the real estate market starts to improve. Also, again, a potential acquisition candidate. This is a tiny company, so one needs to exercise caution with this thing. Next, Okta, OKTA, special situation. Again, cybersecurity business, disaster of a stock, 2021 darling, dumped more than 80% of the value from a notional zero to an all-time high, and has moved up since an October low in 2022. Big accumulation volume here by the looks of it. It's concentrated between around 65 and 73, but up to 92 certainly. And again, I would say this is a company which is likely to be acquired by possibly a financial buyer, would be my guess, because plenty of potential in the company, but it's not desperately well managed in my opinion. So that's Okta, OKTA. Next, PagerDuty, PD, same story. This is a enterprise software company, pretty niche positioning. So it does alerting when something is awry in the data center. 2021, really early peak in 21, February 21, I just sold off straight since then. 78.6 retrace from the move up from the COVID lows to the 2021 highs down to the 22 lows, retested as recently as October 23 and moved up. And then you can see this accumulation volume between, let's call it 20 and let's call it 25. So this is one that, again, I would expect to be sold to another company. Is it going to retain its prior highs? I don't believe it will. Could it make it up to 35? It's March 23 peak, maybe. Might you see a 30, 40, 50% pop on acquisition? Maybe. So this is one where I think there's some potential for this. I bought, added to a position I have in this one yesterday. I'm not sure where to put money into it if I didn't already own some of it, but that accumulation logic is reasonably sound, and so I think that could be acquired. Next one, Twilio, same story. You get the picture, right? Broken 2021 stock, badly run company until very recently when they've had some activist shareholders in, started to turn it around. It's now cash generative. It's starting to grow a bit faster. And again, look at the accumulation. It's really, really strong here. between $40 a share and around $72 a share. So again, this is one I think can start to climb out. I suspect, to be honest, this one can start to climb out by itself because the shareholder base's churn got much more active. It's putting much more pressure on the management team. I'd not be at all surprised to see the CEO spending more time with his family and someone more cash flow focused being brought in to run the company. That'd be a big positive for the stock, in my opinion. So that's Twilio, TWLO, related acquisition that accumulate. I'm sorry. And the final two, Unity, ticker U, again, same story. 2021 darling, disaster of a stock. Silver Lake are at the wheel now, very successful, long-time technology stock investor in both public and private companies. Replaced the CEO recently, which is an excellent move for the business, in my opinion. They are restructuring their customer-facing economics, pricing, contract structure, all of that, long overdue. The company is basically a platform for gaming and video content. And again, I most certainly would expect to see this one move up by itself under pressure from Silver Lake. And I would be very surprised if the company weren't sold at some point in this couple of years. And the playbook for this is Splunk SPLK, which Silver Lake came in and did something similar to. We rated it as an acquisition candidate for some time. It got bought towards the end of last year for a very nice pop. Thank you. So that's Unity U. And then the final one is Viva Systems, VWV. This is a healthcare software business, really nice company, well managed. Growth slowed a bit lately, but this one I think can climb out by itself. So again, seeing pretty substantial levels of accumulation here between, let's call it 160 and 180 a share, maybe up to 188 if you're being a bit generous. And this one I can believe can slowly, climb up by itself. Well-run business, very wide moat, no real competitors in healthcare. So this one I think can do well. For disclosure, I'm long every single one of the accumulate rated stocks that I mentioned today. I own long positions in all of them. But none of these things are gold-plated businesses. None of these things would pass the Warren Buffett only buy superb businesses test. They all have problems. But the reason they're beaten up is because the reason the stocks are all beaten up is because the companies have got difficulties. And my logic in rating them at accumulate is very simple, which is I look at the price by volume behavior. If I see sideways action at the lows for a long enough time, that looks like institutional accumulation. It might not be, it might just be lots of shares turning over between different shareholders. But when there's a reason to think there could be accumulation, such as an activist shareholder or a potential acquisition, then I think that probably is accumulation. And I try to follow along with that. These things can always be wrong, but in the service here, we have a reasonably good track record of spotting companies that are likely to be bought. Can always get it wrong, obviously, but reasonably good track record. And so that's what links, all of the stocks we have, the growth stocks we have rated at accumulate right now. Okay, we have, I think, one question in the system. 1 second. Okay, so I have a question which is, what can we do to keep on in validation points of the Nasdaq? If holding TQQQ, where would you set stops in case the QQQ rolls over? Okay, Jake, it's a great question. I don't have a very direct answer to that. My answer personally is I don't want to stop out on TQQQ. I want to hold it for a long time, because if we just look again at the QQQ chart here, I don't think that the QQQ is finished climbing. I think it can run quite some way. I think it's going to be up in 2024. And so I don't want to stop out. What I prefer to do is hedge. And so, right now, per alerts earlier today, I'm 1-to-1 hedged TQQQ to SQQQ. So that's 1-to-1 hedged in the Nasdaq. So if the Nasdaq goes up or down, the account balance won't change as a result of that. And what I expect is that the short side SQQQ will gain in value over the course of the next few days, maybe weeks. And if so, I would then sell that short side and take the profits generated in the short side and use that to buy additional TQQQ positions at the lows. And again, folks, if you're joining the webinar a bit later, some are, and any of what I've just said about short and long sounds like nonsense to you, go to our website, sessioncapitalresearch.com. click the Indices tab, and all is explained there. And if you have any questions at all, hit the Contact Us button here on the website, bottom of the website. Type in here, and then we'll get back to you right away. So, Jake, I'm sorry that's not a very direct answer, but that's my approach anyway. If you were going to look at TQQQ directly, I don't really know where you'd place a stop. I mean, one answer would have been the wave 3 high, but that's gone now. So I don't know. I don't like stops, to be honest, with these indices. I prefer to use hedging. Sorry, it's not a very good answer. If you post that question in chat, probably other people have some good answers to that. Okay, any further questions or points, folks? Okay, one question in chat. Yeah, okay. Super basic question. It's not a super basic question. It's a good question. What's the short corollary to the IWM? 1 times the Russell. Yeah, good question. I don't know. Hang on a minute. Let's find out. RWM is the answer. That's a Pro Shares Fund, RWM. I'll type it into the chat room here. RWM. There you go. All right, great. No trouble. Anything else, folks, before we finish off for the day? No. Okay. Just to zoom out again. So, to be clear, I still expect 24 to be up. But let's be alive to the weakness in the market right now. It could turn around tomorrow. It could move tomorrow. Of course, it could. We all know that. The key is, again, follow price. Anyone who followed price in 23 did really well. Anyone who listened to TV, financial media, social media, kid at the bus stop, and worried about recession and inflation and interest rates, anyone who did all that in 23 got really hurt, either because they sat on the sidelines making 5% in money market funds and telling themselves that was a good idea, or they actively shorted it and got really hurt, particularly the last 3 months of the year. So the key is follow price. And what price is doing now is going down. That could happen, that could change tomorrow, it could go up tomorrow, but right now it's going down. And so for me, that's the thing to respect. And if one follows price accurately, then you can always do well in markets, because markets are about price and nothing else. Everything else is an input. Nothing else matters. Only price matters. Only price matters. Only price matters. Nothing else matters. Interest rates don't matter. Inflation doesn't matter. Corporate earnings don't matter. Nothing matters. Only price matters. And if not clear enough, only price matters. So our focus always in our work is price. So fundamental analysis of growth stocks, defense stocks, that's all an interesting input. It's quite fun to do. But what really matters is the output price. So what we're focused on right now is prices rolling over in the indices. If it's rolling over in the indices, it may well start to roll over in single name stocks. It hasn't done that much yet. And so that's the short-term focus. If it bounces tomorrow and runs up, well, then price is running up. So we'll follow that. So again, price, follow price. Okay, folks, thanks a lot for being members of our services. We continue to enjoy terrific growth across our business, which is fantastic. Don't forget, any questions at all, reach out by any method, contact form on our website, any of the chat rooms you run, email, anything you like. Thanks for spending your time and money with us, and look forward to seeing you all soon. Thanks a lot.